Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Hi, global investors. Before we get started with today's episode, are you looking to finance your U.S. real estate investment as a foreign investor? Contact universalcommercialcapital.com. They do not require any credit history, employment, income verification, or permanent residency status. All you need to have is the minimum 35% down payment in a U.S. banking institution for 2 months. Rates start at 6% with a 30-year term. The whole approval process can be completed in 30 days. Call 888-334-9039 or email them at info@universalcommercialcapital.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Aaron Fragnito. Aaron is a co-founder of People's Capital Group, host of New Jersey Real Estate Network, a licensed New Jersey realtor, and a full-time real estate investor. Aaron has completed over 250 real estate transactions, totaling more than $35 million, and has a real estate portfolio of over $10 million. His company works with qualified investors to create passive returns through local commercial real estate. So thanks so much for being on the show.
Thanks, Charles. Glad to be here.
So I touched on your background a little bit, but can you dive more into what you were doing before prior to becoming a realtor and full-time real estate investor?
Sure. Well, I majored from Rowan University with an entrepreneurship major, which is a pretty open-ended major. I had a landscaping business, a small painting business before that, but I really didn't know what I wanted to do with my life, like many college graduates. And so I went out to Colorado Springs to actually teach skiing for Steamboat Springs, actually, in Colorado. For about 6 months, I was a ski instructor. And through that, I read a book called Rich Dad, Poor Dad, right? You've heard of that book, right? And of course, changed my life, my friend, changed my life. As many story I'm sure you hear on your podcast, you know, I read that. Actually, I read it around senior year of college. And then I started reading, Donald Trump University books and David Lindahl and all that stuff. And it made it look so easy to start a real estate investment company. And all you had to do was go put up a letter of intent and raise a little money. You're going to buy an apartment building. So I said, well, I don't have any money or experience. So I need to start as a realtor to kind of learn the market and make some money and work my way up from there, you know. So I went back to Jersey. I got my real estate license, and I luckily was able to live at home with my parents at the age of 23, 24, kind of getting started, and that allowed me to get started as an agent because I made about $500 my first 6 months, and I remember my first commission check I made was actually $5,000, and I worked my butt off for it. As you know, your first time you get paid in the industry is the hardest time you get paid, and my broker gave me $500 and said, read the fine print. So I then learned to read the fine print, and at that point switched brokerages, built up a team over time, started flipping houses, and met Seth Martinez, my business partner to this day, and we got started buying income properties, multifamilies.
Nice. What was the main factors that led you to choose real estate as your investment vehicle?
Well, I really wanted to build wealth. I really wanted to be able to have a passive income and not have to, my options when I graduated college was 2009. I remember going to a job fair at the college, and Enterprise Rent-A-Car said that it could start me at $32,000 a year. And by the time I was 65, I could make enough to retire if I put enough away in my IRA. And it didn't appeal to me. And I knew I could do just a little better than that. And my college advisor said, take the job. It's the best thing you got. It's 2009. I said, no way. I have a passion for real estate. I'm going to figure out how to make this work. It was very difficult, but I always, and I still do to this day, have a real passion to own real estate. I see beautiful buildings, and, some are outside of my league and others are right up, my alley. I'm buying real estate now that I've driven past as a kid and a teenager, and, because I buy real estate locally, kind of where I grew up as well. And it's really cool to buy a big, 10,000 square foot building or something that you drove by as a 17-year-old and having no idea how that all works. And now I'm actually the guy buying those large commercial pieces of real estate in town. And so I always had a passion for that. And I'm glad I was able to not take the Enterprise Rent-A-Car job and I follow my dreams.
Can you briefly explain a little bit about apartment syndication to our listeners?
Sure. So apartment syndication is basically when you pool together capital from a handful of individuals. It could be one person, or it could be up to generally 35 or so. But it's basically you're pooling capital together, and those investors are silent investors. They're non-voting members of the LLC. And that means they don't have a voting right, so therefore you're selling them a security, and the SEC is notified when you pool together capital in that way. And it's not too complicated if you have the right SEC attorney, but essentially pooling together capital and buying a building.
Nice. And what markets in Jersey are you guys focused on now? Are they, if explain a little bit about them, if they're C or they're B, what type of properties you guys are kind of focused on purchasing?
Sure. We look for 6 to 25 unit apartment buildings that are C's or B's. We try to make a C into a B, or, that's really our sweet spot. We try to find a C plus and make it a B, and that's a nice place to be in the market. We got started with D's. We got started with, tough real estate in tough areas. And, one of the first multifamilies we bought was on Gunset Ave. It's called Sunset Ave. We figured out after we bought it's actually Gunset Ave. And there would be like murders in front of our property, just tough blocks. So, getting started, we realized that if something looks really great on paper, it may be too good to be true, and location is important. And in the last few years, really improved our holdings. But I'm not the guy who buys the fancy stuff either. I do not buy Class A real estate. That's hard to cash flow on, and also gets hit pretty hard in recessions. So I'm right in the middle of the road.
Yeah, for sure. Like I know that from my first couple real estate investments, it was probably like my third one I purchased, and it was like a C minus kind of, I guess you would say, property, and it was just, what a nightmare to get it going. It's nothing. It's just the difference between a C minus and a C plus makes all the difference between tenants, between everything, your turnover, everything.
Well, there's certain areas you're just not going to get a quality tenant, and it's because you're just not going to want to live there. It's too dangerous an area. So, one of the tests I make is like, am I comfortable there? Driving by, going to the property, going after hours, am I comfortable walking down the street? And if the answer is no, then, maybe it's where you start with real estate investing, but it's not where I found a lot of the wealth was created. You really want desirable real estate that grows in value over time, and is more recession resistant.
Yeah, they're not going to appreciate, and they're going to be a management nightmare. And the property manager you're using for a D is not going to be your C plus and above property manager. That guy's going out to Gunset Avenue with a gun.
It's wild. Yeah. And the management is so intensive for that, and it's so degrading. Oh my gosh, getting yelled at by people, who have their entire rent paid. It's just by the government. It's great. I love it.
So what is your normal course of action or business plan when you purchase a property? Are you guys, you're doing value add to it? Are you refining it, or do you like to sell them, or?
So yeah, we refinance the buildings generally. That's really the best strategy, tax strategy at the end of the day, we feel. We also buy in an area here, North Jersey, where we can really establish a nice amount of wealth growth, equity growth over time. We buy in desirable areas with a lot of people living in a small area. That's North Jersey for you. We're all running into Manhattan every morning and coming back to our apartments every night. So, I buy near train stations that get you into Manhattan in less than an hour. I don't do Manhattan. I buy outside of Manhattan on the Jersey side. And we know these markets really, really well. We've been doing it for about 10 years now. So we know which areas to avoid and which areas are really up and coming and have great opportunities. So you have to know your markets well. But, it's important to stay local like that also. And we focus on, I have sold buildings. We just sold a 25 unit about a year ago, made a nice profit on it. But, when you sell a building, if you don't do a 1031 tax deference, then you're just going to get nailed on taxes. And that's not a good strategy, unless you have like something amazing, the next Facebook you're going to put that money into, then fine, sell and go. But if you don't have the next Facebook and you're doing well on your buildings, and generally 6 units or larger, we cash flow nicely on through good times and bad. And then, real estate's a great place to park your capital long term. As long as it's managed well, we have the management company in-house, which is very, very important to our model. Then you're just going to keep on cash flowing with it. And if you continue to raise that cash flow and lower your expenses over time, the building just continues to grow in value. And then every 4 to 5 years, we refinance, we pull out some equity, we harvest some equity, we pocket a bunch of cash along with our investors, and that money is tax-free money because you're not exiting the investment. Okay, so when we have a 7-unit right now we are looking at, right? And we were like, okay, we could sell the building. We got it at sheriff's sale auction for about $175,000. Okay, it needs another $50,000. Okay, and it's worth about $450,000, or actually as is, it's worth like maybe about $3, and then if we renovate it, it'd be worth like about $5. Okay, so we're like, okay, well we could put another 50 into it, run it for 225, let's say 250 after costs, and then you go ahead and the bank appraises it at 500,000, and the bank says, okay, you can pull out 300,000 of that 500. At a very low interest rate, right? A phenomenally low interest rate. And say, okay, so we would get the 300,000, we get back the 250 we put into the building to buy it and renovate it, and we pocket another $50,000 on top of that in tax-free money. And then, we have 200 grand of equity, so we could always sell the thing if we really want to harvest that equity, but we make about $100 a door, and we have, management company gets a management fee. So, at the end of the day, I'm making a few $100s a month on it, get some tax benefits from it. I got $50,000 back on top of all the money I invested, and I kept every dollar of that $50,000, right? Yeah. Where normally if I made $50,000, let's say I flipped the property, I made 50 grand, I'd have to give about 15 of that to the IRS. So I'm really making about 35, so if you flip a property to make 50 grand, you got to make like 70 grand because you get taxed so heavily on flip profits. So, I've flipped over 50 homes in my career, and that's great. That's grand. You put on HGTV and they tell you to go flip houses and make it look so easy. But the hardest dollar in real estate is flipping houses, fixing some old broken home and making it a beautiful thing that's going to pass an FHA home inspection. Come on, that's a hard job, and there's not a lot of money in it because if one of them loses in the year and you do 10 of them, that one loss could wipe out 3 or 4 wins. Yeah. So they're, and better off getting a job in Enterprise Rent-A-Car.
Yeah, it's funny with what you're saying about doing the refinancing, because that's a business model that not many syndicators do. And I feel it's so great because when you're selling it, you have the capital gains, but you also have any type of that depreciation that was written off. Now it comes and gets recaptured. So it's all, So especially where you are in high tax, the Northeast, you're getting depreciation on that off, comes off, and now they have to pay it back off as well. You know what I mean? They got to pay that back, and they have to pay their capital gains. So it's a great model you have on doing refinancing, especially at the rates we have today.
Yeah, exactly. And then we do a floating rate as well. So if we do refinance into a higher rate, we can kind of protect against that a little bit. So we actually get paid a premium if we refinance into a higher rate in the future. So it's called a floating rate. So that's the way to just kind of hedge your bets against interest rates going up. And again, another long-term strategy. And then the 1031 tax deference at the end of the road. Let's say we own a building for 15 or 20 years and we've exhausted the tax depreciation, and now we want to go ahead and sell it and trade into a bigger building. The 1031 tax deference, you put that money from the sale into a third party in a certain amount of time to identify a similar building and close on it. But you could trade up into an amazingly better building with the 1031 tax deference and defer any tax owed. And now you're leveraging that money as well. So, if you sold a building and you made $1 million, you normally would owe 25% of that to the government, let's say. So you're making $750,000. But if you do, and then if you want to go buy a piece of real estate with that, you're going to get a loan and multiply that 750 times 4. So you're going to buy a piece of real estate for about $2.9 million or so, okay, with $750,000 down. But let's say you do a 1031 tax deference, right? And you sell that building, you get $1 million, you defer the taxes, so now you have $1 million in cash to go buy that next building. And if you execute properly, well, 1 million times 4, that's a $4 million building. So you just went from buying a $2.9 million building to buying a $4 million building, and we all know that's a lot better. So it's an awesome tax strategy.
Yeah, that's fantastic. So what do your partners and you look for when you find and assess potential properties?
Well, we'll look at 400 properties to buy one. There's a lot of different ways to value a property. You obviously have your cash on cash return, your cap rate, and things like that. But really, to get into the nitty gritty, you have to understand your market and be able to. It's a bit of be a bit of an artist. Be able to see opportunity through the clouds, and recognize opportunity where others don't. actually dig into the numbers a little bit and figure out that the owner's brother is on payroll for $52,000 a year and gets a free apartment, but doesn't actually do anything because then there's a management company also getting 8%. And wow, all of a sudden, wait a minute, this is a deal. There's $50,000 a year going in some idiot's pocket that doesn't do anything. This is a deal. I'm going to fire that guy when so, recognize that opportunity, look at a building, I have people that look at buildings and say, oh my God, it's not making any money. I bought a 6-family in Passaic about a year ago. It's making $37 a month in positive cash flow when I bought it. And our investor, who's invested for years with us, said, listen, I trust you guys. I hardly open the things you send me anymore. I just agree to it. But basically, are you sure about this one? It's making $37 a month. And I was like, yeah, trust us. There's a lot of value add in the rents. They're about 30% below market value. So in just a year, we brought the rents up. Now the building's making nearly $3,000 a month positive cash flow, which is 100 times more than it was making before. And the building value, we bought it for $450. It appraised at $550 the day we bought it, the time we bought it, and it's probably worth $750 now after a year of owning it. Even say it's worth $650. Fine. We have 200 grand of equity and it's making money. So awesome investment.
Yeah, that's awesome. It's knowing knowing your market and then knowing the expenses for that market, what it really costs to operate that property, because you're finding a lot of over expenses that are, usually over what we usually consider the 50% mark there, like just very high. But usually in this market or in any kind of market, when you're looking at properties and you'll find, like we were looking at a property and they were saying the management fee was 1%. And we're like, we'll go back to the broker. Well, what management company is managing this thing for 1%? You know what I mean? Yeah. It's completely, so it goes both ways where you're finding just discrepancies in something that you can make more efficient. But what are some red flags that you find when looking at properties that make you take a second look or third look or just pass on it?
Well, a lot of times the red flags are like people that overinflate numbers and just send you, the cap rate's 10%. There's 3 expenses for this building. Oh wow, I didn't know that. That's amazing. I didn't live in a dream world. So it's that's the red flags are all over the place. You want to, we deal with sellers directly a lot of times, and that's always difficult because they are full of tricks and they'll say one thing and do another. And so having brokers involved in a transaction does, I think, help you avoid pitfalls and red flags sometimes, especially on larger transactions. So, we try to work with good brokers that know not to waste our time. Generally, you work with some of the bigger names, Marcus and Millichap, but you start to kind of get with brokers that are experienced and don't want to waste your time because they know a serious guy who's going to really buy this building is going to nail down those numbers. So you might as well do it for me. And they're not going to take the listing if it's a piece of junk deal. So, trying to work with good brokers is a good thing. But then always looking into the numbers further. One time I bought a building and the seller sent us a bunch of bank statements, and the bank statements showed even more rent roll coming in than we thought the building was capable of. We were like, hey buddy, this building's making more money than you told us. Is that true? What's up with your bank statements? He's like, yeah. Well, it's a good building. You see, I told you, see. And so we bought the building. We figured out it was actually like a bunch of other properties that weren't included paying into his bank account that he told us were those properties, and the deposits weren't very clear. And so he tricked us. Now it was still a good investment. There's a bunch of other avenues you use to measure the income of property. But it so happened that about a quarter of the tenants weren't paying rent in the building. And it wasn't the end of the world. We ended up repositioning uncooperative tenants, and then the building ended up being a very profitable investment. But there's a perfect example of a seller that showed us falsified bank statements, basically, by just claiming other income from other properties was the income on that property. And that's something, I guess now I know can be a red flag.
Yeah. There's only so much due diligence you can do. So if you're getting the P&L, profit and loss, you're getting rent rolls, you're getting a T12, whatever, and then you put that toward your bank statement and you're trying to, you're kind of looking at them and looking at the information, and there's only so many ways you would know what's going on. And then the other thing too is once you take over a property as well, somebody's paying late, someone's not paying late. You don't know that. You don't know how strict they are on late fees. So all this stuff has to gets washed out in the first 6 months of you owning a property, and kind of figuring out what is going on to get it going, which isn't the end of the world, but it's something that can kind of slow down the whole value add process that you're trying to do.
Right. A lot of the research we're doing isn't always on the building. Like that building in Passaic I bought for 450,000. Like, so I know that I'm going to work with all the tenants there and do cash for keys. So really, whatever the building's doing right now isn't all that important. You're buying a good building in a good area. It's in good condition. You have an inspection of the property done, and physically it's in good shape. And that there's room to improve. So whatever the owner's collecting isn't all that significant, because he's a bad property owner, and that's why he's selling you the property for 25% off, and you're going to do better than him. So you also have to have confidence in your system. But another time I bought a property from a guy who was the town inspector, and it was a big mistake, because he ended up just finding us. A tenant put a TV on the corner for a few days one time, and he fined us $11,000 because he thought we bought the property at too cheap a price from him. And
Jeez.
We got a great deal on it, but he was angry after the closing, so he just nailed us on fines. And I learned that day that don't buy a property from the town inspector.
So with passive investors that invest through you, how are you usually compensated through a syndication? Say you're doing a refi on a property. You take over a property, your plan is to refi it, say in 3 or 5 years. How are they compensated on that?
Sure. So our investors own a percentage of the LLC. We create a new LLC for every purchase, create a small fund for every purchase. So if you own 10% of the LLC, you get 10% of the cash flow, 10% of the tax depreciations at the end of the year. And then we refinance the building. We buy it cheap, we force value into it, we get better cash flow out of the building, we get our expenses down, figure out more ways to make income on the property, and then we go to refinance after about 4 to 5 years of doing that.
Mm-hmm.
And now the building appraises for a much higher value, so we pull out a 70% loan to value amount, 70% of the property value, not too much, a safe amount, but a higher amount of debt. We pay off our old debt, so there's cash left over from the cash out refinance, and then we split that up amongst the investors. So if there's $500,000 left over from a cash out refinance, you own 10% of the LLC, you get $50,000 that day at the refinance.
Nice. When you're speaking to new investors, and I imagine you do this as being a real estate agent, as well as just working in general and networking, what advice would you give to new investors, maybe that haven't started? Avoid mistakes you made, of course, but what other things would you say?
Well, yeah, based on some of those stories there, at the end of the day, the easiest money I made in real estate was being a listing agent as a realtor and owning income properties. Okay, now the property management end of it was a tricky thing to learn, and develop a property management company took many years to really perfect that craft. But I have to give people, a warning: do not just jump into fix and flips. Right? There's so many people that go to these guru events, and they're like, "Yeah, go buy my $30,000 book and CD and start flipping houses." Like, that's crazy, because flipping houses is a construction company. You're starting a construction company. You're going to be a general contractor, or hire a general contractor that knows a lot more than you about construction. And whatever he tells you, you're probably going to go with, unless you're smarter than your general contractor and know construction better than him, which if you were, you probably wouldn't need to hire him. So, getting tricked by your contractors with fix and flips is just going to happen. It's part of the business. They're going to tell you one thing and do another. They're going to be great for years, and one day they'll just never show up again. They'll break your heart. They'll promise you they could do a job for 100, and it really costs 200 at the end of the day. And oops, that's your problem now. He's nowhere to be found. So, all these things happen with contractors. Construction projects are precarious. They're so many moving pieces. You have town inspectors, you have architectural drawings, you have the town needs to vote on variances and things like that. So flipping houses is the riskiest way to make money in real estate, in my opinion. It's the most difficult, it's the most complicated, and it's the highest risk by far. So that's why we developed our company, People's Capital Group, because buying apartment buildings isn't easy, and managing them is definitely an acquired taste. But over time, once you really perfect the ability to find these good deals, analyze properties properly, and recognize that value add, And then the other half is knowing the local town ordinances, knowing how rent control works, knowing how to structure these acquisitions, how to have a relationship to banks so you get really good terms on your money that you're getting to buy the real estate. All these things are important. The management of the real estate afterwards for 5, 10, 15 years. There's a strategy for each block of time, and one more aggressive, less aggressive, moving forward over time. And so you have to be able to execute. But if you can do that, or work with a company like ours where you can invest passively and get all those benefits, then it's really a better way to make money in real estate. People always need a place to rent. Flipping houses, if the market drops out, good luck. But if you own income properties in a good area where a lot of people want to live, middle of the road real estate, not the most expensive guy in the block, not the cheapest, people are going to want to rent your space. They're going to pay for it.
Yeah. No, flipping house for sure is very high risk. And they always tell you when you're going to any type of these seminars, and it's 13%, you get your money at 13% with 3 points and all this kind of stuff. And, it's extremely high, but you're going to make all this money. And the biggest problem we had when we did flipping years and years back was finding having the crew consistently to do the work. And I was full-time in real estate, and even doing that, I don't know how people would even do it part-time, because the project management on it, it's not like you just show up every 2 weeks and check on your project. It's a daily thing.
Daily.
You know what I mean? Where you have to be there, let people in, make sure that stuff's getting done. You have to cut checks. Somebody puts the HVAC system in at 9 a.m. They're not going to wait till 7 p.m. for them to get their check. They want it when they're leaving and all this kind of stuff. So,
yeah.
But anyway, thank you very much for being on. How can listeners learn more about you and your business?
Sure. Our website is peoplescapitalgroup.com. That's peoples with an S, peoplescapitalgroup.com. And we have events here at the office every week. We have webinars as well. And we actually have a meetup group called New Jersey Real Estate Network with over 3,300 members in it. And that's New Jersey Real Estate Network, meetup.com.
Okay, awesome. Well, I'll put all those links and all that information into the podcast notes and the YouTube notes. So I want to thank you very much for being on the show today, and I look forward to speaking with you soon.
Great. Thanks a lot. Have a good day, Charles.
You too. Hi, guys. This is Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in investing in real estate and you don't know where to begin, set up a free 15-minute strategy call with me at schedulecharles.com. That's schedulecharles.com.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Harborside Partners Incorporated exclusively.